Costco. The name alone conjures images of bulk buying, treasure hunt shopping, and those addictive $1.50 hot dog combos. But behind the spectacle lies a retail giant with a remarkably loyal customer base and a knack for navigating economic storms. Costco's success story is anchored in its membership model. This isn't just about exclusivity, it's about creating a sense of belonging. Customers pay an annual fee for the privilege of shopping at Costco, and they're rewarded with low prices and a constantly rotating selection of products. This model creates a powerful feedback loop. The more members Costco has, the greater its buying power, allowing it to negotiate even lower prices from suppliers, which in turn attracts even more members. But Costco isn't just about low prices. It's about the thrill of the find. The retailer is known for its eclectic mix of products, from diamond rings to kayaks to giant tubs of mayonnaise. This treasure hunt atmosphere keeps shoppers coming back for more, eager to see what hidden gems they might uncover. And let's not forget about those legendary low prices. In an era of soaring inflation, Costco has consistently managed to keep its prices low, even on everyday essentials. This has made it a haven for budget-conscious consumers looking to stretch their dollars further. Costco's winning formula of low prices, treasure hunt shopping, and a loyal membership base has made it one of the most successful retailers in the world. But as we'll see, even the best companies can become overvalued. All right, let's pop the hood and take a look at Costco's engine. Over the past year, Costco has continued its steady growth trajectory. They've seen solid revenue growth, with comparable sales figures consistently outpacing those of traditional retailers. This tells us people are still flocking to those giant warehouses, memberships in hand, ready to spend. Earnings per share, the holy grail for many investors, have also been on the rise. This indicates that Costco is not only growing its top line, but also becoming more profitable. Now that's a beautiful combination. It's clear that Costco's business model is firing on all cylinders. However, we can't ignore the whispers in the market. Some analysts are starting to raise eyebrows at Costco's valuation. The stock price has been on a tear, reaching levels that some consider frothy. While Costco's financial performance is undeniably strong, the question remains, is the market getting ahead of itself? Is the stock price justified by the underlying fundamentals? We'll delve deeper into these concerns in the later sections. Let's talk margins, folks. It's where the rubber meets the road in retail. Costco operates on razor-thin margins, intentionally keeping prices low to attract and retain those loyal members. This is in stark contrast to competitors like Walmart and Target, who rely on a more traditional retail model with higher markups. So how does Costco do it? Volume, baby. They move massive quantities of goods, compensating for those slim margins with sheer scale. It's a high-wire act, but they've mastered it. But here's the catch. Costco's low-margin approach leaves little room for error. Any hiccup in the economy, any unexpected cost increase could put pressure on those already thin margins. And let's not forget the competition. Amazon is breathing down everyone's neck in the retail space. And even with its membership model, Costco isn't immune to the e-commerce giant's reach. Section 4. Sharing the wealth. Dividends and cash flow. Now, let's talk about something investors love: dividends. Costco has a history of rewarding its shareholders with a steadily growing dividend. They've been consistently increasing their payouts, a testament to their strong cash flow generation. Costco's membership model provides a predictable and recurring revenue stream. This cash flow stability allows them to reinvest in the business, pay down debt, and yes, return money to shareholders through dividends and buybacks. But remember, a high dividend yield can sometimes be a red flag. It can indicate that the market is skeptical of a company's future growth prospects, pushing the stock price down and inflating the yield. While Costco's dividend growth is impressive, it's crucial to consider the bigger picture. Are those dividends sustainable in the long run? Can Costco continue to grow its earnings and cash flow at a rate that supports further dividend increases? Section 5. Balancing act. Capital allocation and share buybacks. Costco has been a busy bee in the capital allocation department. They've been repurchasing their own shares, a move that can be interpreted in two ways. On one hand, it can signal that the company believes its stock is undervalued. By buying back shares, they're essentially reducing the number of outstanding shares, which can boost earnings per share and make the stock more attractive to investors. On the other hand, share buybacks can also be a way to mask slowing growth. If a company can't find attractive investment opportunities, it might resort to buybacks to artificially inflate its earnings per share. In addition to buybacks, Costco has been investing in its future. They've been expanding their warehouse footprint, both domestically and internationally. They've also been investing in their e-commerce capabilities, recognizing the need to compete in an increasingly digital world. The key here is balance. Costco needs to strike a balance between rewarding shareholders in the short term and investing for long-term growth. Section 6. The price of success. Overvaluation concerns. Here's the million-dollar question. Is Costco overvalued? Look, Costco is a fantastic company, but even the best companies can become overvalued when the market gets carried away, and that's what we're seeing now. Costco's stock price has been on a tear, reaching historical highs. Its price-to-earnings (PE) ratio, a common valuation metric, is significantly higher than its historical average and higher than many of its peers. This suggests that the market is pricing in significant growth for Costco, perhaps even more growth than is realistically achievable. Now, some might argue that Costco deserves a premium valuation because of its strong brand, loyal customer base, and recession-resistant business model. And they're not wrong. But there's a difference between a premium valuation and an unreasonable one. The market is a fickle beast, driven by emotions as much as by fundamentals. While Costco's long-term prospects remain bright, there's a real risk that the stock price has gotten ahead of itself. Section 7. Investor Takeaway. Proceed with caution. Here's the bottom line, folks. Costco is a great company, but it's not immune to the laws of gravity. The stock is currently priced for perfection, and even the slightest misstep could send it tumbling. If you're a long-term investor who believes in Costco's story and you're comfortable with some volatility, then by all means, consider adding it to your portfolio. But do so with caution. Don't chase the stock price. Wait for a pullback, a chance to buy in at a more reasonable valuation. Remember, investing is a marathon, not a sprint. And in the long run, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price.